this outdated technique is used in accounting to this day, despite the transition of accounting from paper to computer. You see, the conceptual framework is incorrect. That is why the profit and loss accounts are present on almost all national and corporate charts of accounts, while you can hardly find there a cash flow account. As long as income accounts are not closed before the so-called balance reformation, the system intentionally allows for a failure and disrupt the balance equation of resources and claims. But why on earth do I have to close something at all to prepare statements? Because of the lame accounting. Instead of preparing financial statements, we can simply have them always at any time. In other videos, we have repeatedly talked about how modern accounting is weak in terms of meeting the needs of financial reporting. Invented more than 5 centuries ago, the double entry in the debit and credit of accounts is able to provide only a small part of the financial statements data. But this outdated technique is used in accounting to this day, despite the transition of accounting from paper to computer. Let's try to figure out what is wrong with this technique, what are the defects of the double entry, and how to fix them. The double entry method in accounting is a natural consequence of balance sheet equality. Since the left side of the balance sheet should always be equal to the right side, any change in one balance sheet item causes an equal change in another item or items. The balance sheet can be presented in the form of 10 scales. There are masses put on both left and right sides. I prefer terminology from the Conceptual Framework for Financial Reporting of IASB. Resources and claims. So the left pan holds blue masses, the resources items. The right one carries red masses, the claims items. The masses can be of various shape, size and weight, but all of them are made of the same stuff, which represents a uniform nature of the balance sheet figures. All of them are measured at the same point in time. It's very important. The scales are balanced. The weight of resources is equal to the weight of claims. Whatever economic event occurs, and however they amend the value of individual resources or claims, their total equality must be maintained at all points in time. What if we remove one blue mass from the left pan? To keep the balance, we must do something, and we have 2 choices. Put another blue mass of equal weight on the left pan, or remove a red mass of equal weight from the right pan. We should act likewise in any other cases when removing or adding masses. In other words, in order to keep the pans in equilibrium, any manipulation with masses should be counterbalanced by another equivalent manipulation. This is where the double entry technique originates. If an economic event has resulted in posting a debit entry of a certain amount to one of the accounts, then exactly the same amount should be recorded on the credit side of another account or several other accounts. If you handle only 2 categories, resources and claims, and disregard the composite entries, you can easily distinguish 4 types of impact of economic events on the balance sheet. We can write down these 4 types of paired balance effects as the accounting entries. Debit R, credit R. Debit C, credit C. Debit R, credit C. Debit C, credit R. Nowadays, the mentioned 4 types of impact of economic events on the balance sheet can be found virtually in all textbooks on accounting theory. But what ensures that balance sheet equality which gives accounting theories the right to exist? Why should resources be equal to claims? To answer this question, we need to differentiate claims by separating claims against the entity that are due to the third parties, the liabilities, from claims against the entity due to the shareholders themselves, the equity. So instead of claims, we've got liabilities plus equity. The last one is very interesting phenomena. The very word equity is a single root with the word equality. How do we define equity? I will simply quote the definition from the Conceptual framework, paragraph 463. Equity is the residual interest in the assets of the entity after deducting all its liabilities. This is the basis for the equality, the measurement of the equity. Since the equity is measured as the difference between resources and liabilities, the amount of liabilities and equity should automatically equal the resources. But if the equity would be measured in some other way, then there would not be a classical balance sheet equation. Why not measure the equity, for example, at fair value? There is already a prototype for this approach, the measurement of non-controlling interest in IFRS 3 business combinations. Well, we'll discuss this idea in another video. But now, do not panic. I'm not going to destroy the theory of accounting offering alternative options for measuring equity. We will remain at the presumption that the sum of liabilities and equity is equal to resources. Coming back to our scales model, let the masses representing the liability items be red and the masses representing the equity items be purple. Our pans are still in equilibrium. The weight of resources is equal to the total weight of liabilities and equity. And the equality must be maintained at all points in time. What if we remove one blue mass from the left pan again? Now, to maintain the balance, we have 3 options. Put another blue mass of equal weight on the left pan, remove a red mass of equal weight from the right pan, or remove a purple mass of equal weight from the right pan. And we do the same in any other case of removing or adding masses. Taking into consideration that we now handle 3 categories, resources, liabilities, and equity, the number of types of the impact of economic events on the balance sheet has grown from 4 to 9, because 2 times 2 is 4 and 3 times 3 is 9. We can write down these 9 types of accounting entries. Debit R, credit R, debit R, credit L, debit R, credit E, debit L, credit R, debit L, credit L, debit L, credit E, debit E, credit R, debit E, credit L, debit E, credit E. That's all. This system of accounting entries works perfectly well if it deals with the statement of financial position. All 3 categories, resources, liabilities, and equity, are measured at a specific point in time. We can call such indicators as stock indicators, or in terms of XBRL, instant indicators. But financial statements are designed to reflect not only the financial position, but also changes in it. In order to show the changes, we can still use instant indicators. Here's the data at the beginning of the period and there's the data at the end of it. Thus you can see how they have changed. Unfortunately, users of financial statements would never be satisfied with this. They want to see the very changes. They want to see the flows. In other words, users of financial statements want to see indicators measured over a certain period of time. We can call such indicators as flow indicators, or in terms of XBRL, duration indicators. The number of duration indicators in financial statements is much greater than the instant ones. According to the Conceptual Framework for Financial Reporting, paragraph 3.4, financial statements are prepared for a specified period of time, reporting period. There are no exceptions for some particular statements. You see, the conceptual framework is incorrect. The very first statement that we see in financial reporting is not prepared for a specified period of time. All the other statements may be, but not the first one. The statement of financial position is prepared for a specific date. This inaccuracy in the conceptual framework shows the importance of duration indicators in the financial statements. They are so dominant that the authors of the conceptual framework simply forgot about the instant indicators. But the classical system of accounting entries is designated for the financial reporting minority. It is able to work only with instant indicators because it is built on the equality of resources and claims measured at a certain point in time. This system ceases to work properly and stalls when it is trying to adapt to the formation of duration indicators. Such attempts have been made since the middle of the last century, but all that has been achieved is to come up with accounts for a very narrow part of the duration indicators. As a matter of fact, it is yet only about the profit and loss accounts. And these accounts work poorly. The profit and loss accounts are alien elements for the balance sheet, in which all its elements must be measured at a point in time. Profit or loss is measured over a period of time. The double entry system is well balanced. It can work only under conditions of equilibrium of the left and right scale bands, or in the language of mathematics, provided that the sum of all its elements permanently equals to zero. The main advantage of the double entry accounting is at the same time its weakness. You cannot just add something to it from outside without disturbing the balance sheet equality. As they try to solve problems of duration indicators on the basis of instant equality, they don't just add the profit and loss accounts to the system of balance sheet accounts. The duration accounts replace the instant accounts. Therefore, the area where we try to tackle the problems of duration indicators this way is exactly the area where we lose the possibility to solve the problems of instant indicators. Let's take the classic account of profit or loss for a period. Entries into this account being made throughout the year take place instead of the records on account of equity, retained earnings. We are unable to see the current state of equity in general and retained earnings in particular until the balance of the profit account is equal to zero. We'll have to perform special additional procedures to see it, and the account of profit for a period sets to zero only once a year, when the annual financial statements are prepared. Only at that point in time, accounting demonstrates the current value of retained earnings and equity. All the rest of the time, the balance of the account of profit for a period is not equal to zero. So we can say that the equity is not accounted. Truly speaking, people on the ground do not yet see the urgent need for being aware of the current equity value, unlike other balance sheet items, such as money, for example. Apparently, that is why the profit and loss accounts are present on almost all national and corporate charts of accounts, while you can hardly find there a cash flow account. As for the equity, it's not that important to know the current state of its items and its total value every day to manage a business. If necessary, it can be calculated manually beyond the system of accounts. And at the end of the year, the appropriate figure will be disclosed anyway. In case of money, the situation differs. Nobody is going to be satisfied with the information about the available money compiled as late as at the end of the year, after a bulk of closing entries. The information on available money is what's required every day in real time. What would happen if you tried to organize cash flow accounting in a similar way? We need to introduce at least 3 accounts for them, one for each class of cash flows: operating, investing, and financing. Once there is a movement of money, we would use these accounts and the classical double entry method with the usual correspondence with other accounts. We would reflect cash inflow on the debit side and cash outflow on the credit side. For example, the payment to the property, plant and equipment supplier will be reflected by the debit entry into the account payables to suppliers and the credit entry into the account investing cash flows. In this case, the cash flow account participates in the entry instead of a money account. At the end of the year, all 3 cash flow accounts will be set to 0 by the closing entries into the money accounts, just like it is done presently when the accounts for profit and loss for the period are set to 0 by the closing entries into the retained earnings account. Accordingly, the accounting information about the entity's available money can only be formed once a year after such reset. Of course, it's out of the question. This is the reason why almost no one even tries to introduce accounts for cash flows. They are reported beyond the system of accounts and bookkeeping records. And now let's remember that the list of duration indicators in financial reporting goes far, far beyond the profit and loss and cash flow items. What about the items of other comprehensive income, contributions of shareholders, dividends and other withdrawals? After all, what about all assets and liabilities movements for a period? Are they not required to be reported? Open IAS 37, paragraph 84. For each class of provision, an entity shall disclose additional provisions made in the period, including increases to existing provisions, amounts used, incurred and charged against the provision during the period, unused amounts reversed during the period, and the increase during the period in the discounted amount arising from the passage of time and the effect of any change in the discount rate. Open IAS 16, paragraph 73. The financial statements shall disclose for each class of property, plant and equipment a reconciliation of the carrying amount at the beginning and end of the period, showing additions, assets classified as held for sale or included in a disposal group, acquisitions through business combinations, increases or decreases resulting from revaluations and from impairment losses recognized or reversed in other comprehensive income, Impairment loss is recognized in profit or loss. Impairment loss is reversed in profit or loss. Depreciation. The net exchange differences arising on the translation from the functional currency into a different presentation currency. And other changes. Similar requirements are imposed on changes in almost every balance sheet item. If you try to introduce accounts for all of these indicators for a period the same way as it has been done in respect to income and expenses, all balance sheet figures at a date would be eliminated from accounting. It's definitely not the right way to keep accounts. Impossibility to invade the balance sheet without violating its equilibrium is exactly the reason why the satisfaction of the needs for duration indicators has limited to just a few accounts for income, expenses, profit and loss. Accounting methodology has not progressed any further, since it faced an ever-growing resistance on its way. Any further movement along this path will inevitably lead to the destruction of the double entry system. Thus, a kind of a ceasefire has been arranged in the struggle between besieged balance sheet and the growing demand for duration figures in financial reporting. But this truce definitely does not suit any of the parties. Let's come back to our scenery with the scales and masses. Let's try to forget for a moment that the masses are there to present the financial position indicators, resources and claims. Let's just focus on the necessity for keeping the pens permanently balanced. Is there other way to counterbalance the manipulation with the masses? Suppose the pens can hold liquids and will use water. Why not? The only thing that matters is the appropriate weight of water. Suppose a blue metal mass was added to the left pen. It could be counterbalanced by other equal metal mass, but instead we carefully pour some water of the equivalent weight into the right pen. The scales stay balanced. Yes, technically it's true. But the equality has now lost all meaning. Initially, the scales represented the balance of resources and claims. But now the equilibrium does not prove but rather refutes their equality. The water in the pen indicates that the resources are no longer equal to the sum of liabilities and equity. That's exactly what happens in present-day accounting. A canonical bookkeeping entry that reflects the revenue of a retail outlet can serve as a good example. Debit cash, credit revenue. The entry is notable for the fact that it involves the debit side of an instant account and the credit side of a duration account. The flow is equated to the stock. Two differently dimensioned indicators at the date and over the period are just equated to each other. Incommensurable things are combined in a single equation. This is the same thing as balancing the scales with substances being in different states of matter, solid metal masses and liquids. The most interesting thing about this entry is its impact on the balance sheet. Oddly enough, only one item has been changed in resources and claims: cash. Resources have been increased, but the increase has not been compensated at all. Resources have grown, but the sum of liabilities and equity has remained the same. It appears that the balance has been broken. Indeed, we should always change two items at the same time and in equal proportion to maintain it. This is what underlies the fundamental principle of double entry accounting, based on the balance sheet equation. And in this case, the principle is not upheld. Of course, later on at the end of the year, while preparing statements, it will come to the second item. Ultimately, the amount recognized on the cash account will find its symmetrical pair. It will get to the equity account. But when is it going to happen? As long as income accounts are not closed before the so-called balance reformation, the system intentionally allows for a failure and disrupt the balance equation of resources and claims. The failure is almost indiscernible because the balance sheet has only lost one indicator: retained earnings. But nevertheless, it does have lost it. The balance has been broken, at least temporarily. Come back to the classical balance equation. R equal L plus E. This is an algebraic expression for our scales. The equation is remarkable for it can be not only expressed in amounts of money, but also defined in time. The equation holds true for any particular point in time. In the case of our scales, it means that all the masses are made of the same substance. If we would only see the reflected amounts of money in the entry debit, cash, credit, income, we wouldn't observe any breakdowns of the balance. Arithmetically, the balance equality is preserved. The double entry system prevents from breaking it. The sum of records on the debit side must be equal to the sum of records on the credit side. And indeed, they seem to be equal, but there is no sense in this equality anymore. It is disoriented in time. All the balance sheet items, except for retained earnings, are now presented by values as of the current date. And the retained earnings item is an exception. Its value holds as of the beginning of the reporting period. Therefore, the balance sheet items are not balanced between each other anymore. Currently, the balance is maintained by a new item, not included in the set of balance sheet items, namely revenue for the period. Solid masses are counterbalanced with liquid. There are incommensurable substances on the scales. In other words, the disturbed balance equation between the values at the date is compensated by a value over the period. The equation stays, but it has become not quite a balance sheet one. We can draw a mixed equation as resources plus expenses equal liabilities plus equity plus income. Since the equation is expressed in monetary units, it is arithmetically correct. But the expression overturns the classic balance sheet. Since income is not equal to expenses, it implies that the resources are not equal to the sum of liabilities and equity. Attempts to identify the units of time used in this expression reveal its pointlessness. It's no longer possible to identify a single point in time for all members of the equation. Assets and liabilities are now denominated in monetary units as of the current date. However, the income and expenses are expressed in monetary units over the period from the beginning of the reporting year to the current date. As for the equity, it is impossible to identify its time parameter at all. Retained earnings seems to be expressed in monetary units as of the beginning of the reporting year, while the other equity items as of the current date. But even this is not so definite. Just imagine that the entity has paid or accrued dividends. Such a transaction should be recognized on the debit side of the retained earnings account immediately as an appropriate economic event occurred, and not at the end of the reporting year. What does the balance on the retained earnings account show after the entry is posted? What date should be assigned to the value generated on the account? It is not be taken as a value as of the current date, because it does not include the profits earned from the beginning of the reporting year. But it cannot be considered a value as of the beginning of the reporting year either, as it includes the results of economic events occurred after the date, such as payment of dividends. It turns out that the current value of the account of retained earnings cannot be assigned to a specific point in time throughout the reporting year until the accounts of income, expenses and profit for the period are closed. It brings no economic sense. And of course, the balance equation drawn up using such a value would be absolutely meaningless. Woefully, the present-day accounting works on such a malformed basis. This is the main reason for the long preparation of financial statements. When the preparation of reporting is reduced to 1 month, this is already called fast close. But why on earth do I have to close something at all to prepare statements? Because of the lame accounting. Contemporary accounting deals with the indicators of 2 dimensions. Some of them are measured at a certain point in time, while others for a period of time. Everybody seems to know about that, but this knowledge is passive. Nothing follows from it. Accounting pays attention only to the monetary aspect of measurement, while virtually ignoring the temporal aspect. Statics and dynamics try to coexist and be equalized within one balance, which is then the cause of its losing bearings in time. The indicators of different dimensions participate in the same entry on its debit and credit sides. To cure the situation, accounting has to differentiate all accounting indicators according to their period type. Instant or duration. Statics and dynamics are indeed different accounting substances that require different styles of approach. In order to obtain a several-dimensional image of business, we need a tool that is fit to work in several dimensions. Accounting is really able to become such a tool. Instead of preparing financial statements, we can simply have them always at any time. All quantifiable information required by financial reporting users, including any notes, can be obtained in real time as primary data is entered. Entries into accounts could and should be the equivalent of entries in reporting lines. But for this, we need to fundamentally change the system of accounting entries. How to do it? I'll tell you in another video.